All right, class, welcome to Today we're going to build on our course material and really analyze one of the most important financial decisions any Canadian entrepreneur is ever going to make. We are doing a deep dive into the strategic choice of whether or not to incorporate a business here in Canada. And let me be clear, this is so much more than just paperwork. It's a foundational decision that will shape everything: liability, taxes, and the entire financial future of a company. So, here's our game plan for today. We'll start with the basics of business structures. Then we'll get into the critical ideas of liability and, of course, tax. After that, we'll look at the long-term picture and finally wrap up with a framework to help make the right call. Okay, first things first. Before we can really appreciate what makes a corporation so unique, we need to understand the other options on the table. So let's do a quick review of the main business structures you'll see in Canada. This table pretty much gives you the entire lecture in a single snapshot. On one side, you've got the sole proprietorship, where you and your business are legally the same thing. And on the other, the corporation, a completely separate legal person. That one difference, it's the source of almost every pro and con we're going to talk about today. Now let's dig into the first huge advantage of incorporating, building what I like to call a great wall between your business's risk and your personal assets. This quote just nails it. A corporation is its own legal entity. It can take on debt, it can get sued, and its problems are its own problems. This legal separation is the foundation of what we call limited liability. So, the bottom line is this protective wall. As a sole proprietor, if the business goes under, creditors can come after your house, your car, your savings. With a corporation, they generally can't. Now, there's a big caveat here. If you personally guarantee a business loan, well, you've just poked a hole in that wall, making yourself personally responsible for that one debt. Okay, let's get into the most complex part of this. And honestly, for a lot of people, the most powerful reason to incorporate: the tax advantages. This is where the numbers really start to talk. Now, to get the best tax rates, a business needs to be set up as a Canadian-controlled private corporation, or a CCPC. You need to know this acronym. This status is designed specifically to help Canadian-owned businesses, and it's basically the key that unlocks the powerful tax tool we're about to look at. And here it is, the small business deduction, or SBD. This is the big one. It's the main way corporations can pay a much, much lower tax rate on their first $500,000 in profit. This is the engine that drives the whole tax deferral advantage. To really appreciate the power of the SBD, you have to look at the alternative. As a sole proprietor, all your business profit flows right onto your personal tax return. And as you know from this course, that income can be taxed at rates as high as 50%. Now compare that to the same profit earned inside a CCPC that qualifies for the SBD. Suddenly, that profit could be taxed at a combined rate of around, say, 13%. The difference is just incredible. Yeah, that difference is staggering. We're looking at a 37% tax deferral. Now, pay attention to that word deferral. It's not tax elimination. You will pay more tax later when you take the money out for yourself. But in the meantime, that deferred tax is cash that stays in the corporation, cash you can use to hire people, to expand, to invest. It's a massive, massive cash flow advantage. Of course, there's a catch. The government wants this low tax rate to be used for running an active business, not for creating personal investment piggy banks. So if your corporation starts earning too much passive income, like interest from investments, your access to the SBD gets reduced. It gets ground down. Let's see how that works. This example with Joe the doctor is perfect. So in step 1, his corporation makes $120,000 in passive income. Now the rule, step 2, is that his limit gets reduced by $5 for every $1 he's over the $50,000 threshold. So the calculation, step 3, shows he's $70,000 over, which leads to a whopping $350,000 reduction. Which means step 4, his new limit for that low tax rate is only $150,000. And the passive income grind isn't the only limit. The CRA also has rules to stop people from just opening up 10 different companies to get 10 SBDs. If your corporations are considered associated, they have to share one single $500,000 SBD limit between them. Now, the rules for what makes corporations associated can get really complex, but here are 2 classic textbook examples: a simple parent company subsidiary relationship, or one person controlling 2 different companies. In both of these cases, those businesses have to share the SBD. And this slide brilliantly illustrates just how deep the rabbit hole goes. It's not just about direct control. Here, just because Mrs. X owns a big chunk of shares in her husband's company, the tax law says their separate businesses are associated. This is exactly why you need professional advice to navigate this stuff. Okay, let's shift gears and talk about the end game, your exit strategy. The lifetime capital gains exemption is another monster tax advantage that is only available to owners of a corporation. When you sell the shares of your qualified business, you can potentially pay zero tax on nearly $1.25 million in capital gains. For building real long-term wealth, this is an absolute game changer. So beyond all the tax savings, the corporate structure itself is just a powerful machine for growth and for building something that lasts. Let's explore how that works. Just think about it practically. You can't really sell a piece of a sole proprietorship, can you? But incorporation creates shares. Those are actual assets you can sell to raise money from investors. This formal structure also boosts your credibility. And critically, it creates a business that can live on long after the founder is gone. That's essential for succession planning, and it opens up strategies like income splitting. All right, so now that you get the why of incorporating, let's quickly touch on the where. You actually have a choice. You can incorporate federally or at the provincial level. Honestly, this decision really just boils down to your ambitions. If you plan to operate across Canada, federal incorporation gives you name protection everywhere. But it comes with a bit more paperwork. Provincial, like here in Ontario, is usually simpler and a bit cheaper if you know you're only going to be operating locally. So, we've covered a ton of information. How do you put it all together to make the right call for a specific business? Well, it really comes down to asking a few key strategic questions. The answer is right here. This is your checklist. Is your business making good money? Do you have liability risk? Do you want to sell it someday and use that huge capital gains exemption? Are you planning to reinvest profits to grow? Are you looking for investors? If you're nodding yes to these, the needle is pointing very strongly toward incorporation. So as you all move forward in your careers, whether you become entrepreneurs yourselves or you advise them, I want you to remember this. The decision to incorporate and how you set it up, that's not just a box-ticking exercise. It is a fundamental strategic tool. It is the financial blueprint for the entire future of the business.